All right, I'm Sylvester Mobley, managing partner, Plainsight Capital. We are an early stage, so pre-seed to seed. I usually say to people, because we're in Philly, we're true pre-seed. We'll invest pre-revenue. So we invest in product-led companies or hybrid product-led companies that scale horizontally. So we won't invest in vertical SaaS companies. And we invest anywhere in the country. I'm going to pass it to my left so we can do short intros.
Hi, everyone. I'm Kofi Ampadu. I'm a partner at Andreessen Horowitz. I'm the head of the Talent Times Opportunity Initiative there. What we do is we are an accelerator and a support system for founders. We invest in founders who we believe have the talent and drive to build big companies, but unfortunately don't have an opportunity to do so. We invest in them and then put them through a 16-week hybrid accelerator program. And then after that program, we help them raise more capital. So excited to be talking to you guys today.
Hi there, I'm Nick Valeriano. I'm an investor with Robinhood Ventures, also part of Mid-Atlantic Diamond Ventures, and we look at a lot of different startups throughout the Philadelphia ecosystem and outside of Philadelphia as well.
Hi, John Beschen, Managing Director for Ben Franklin Technology Partners Tech Team. So we do everything but the health side. Basically, we invest in very early stage startups all the way through about Series A, and then we have a follow-on fund called the Go PA Fund, which invests $1 to $2 million in Ben Franklin companies, and those are any of the Ben Franklins, not just the SEP. So that's where we focus.
Cool. All right, so I'm going to give some warnings before we get started. One, I'm a bad moderator because I have a lot of opinions. I'm a former founder, but I'm also an investor. So I was putting together questions and looking at these questions and thinking to myself, I have a lot of thoughts on these questions. So I'm going to warn you now, I am a bad moderator. I'm also going to warn you I have a lot of opinions. The purpose of this panel is about building lasting relationships with investors, but I do want to couch it in the context of the current market. One of my first questions for the panel is, can we just set the context? Everyone keeps talking about the market, and the way capital is, and the lack of capital, and whether or not investors are investing. So I just want to throw it out to the panel. What is the state of the market from your perspective?
I guess
If you want, yeah.
I'll start. So money's no longer free. I think that's the state of the market. I think in 2021 and 2020, we lived in a zero interest rate environment. So money was essentially free, and it was easier to raise around. When I say easier, it's relative, right? Because depending on what you look like, you also have systemic things in your way when you're raising capital. So capital was a lot more easier flowing through the system back then. And now and investors were also, I think, doing a lot of light diligence, because you would invest in a seed round, somebody else will mark up that round, it becomes a Series A, so you were constantly doing deals. Now that I feel like capital is not freely flowing through the system, what's happening is longer diligence cycles. Some investors are retreating to bad behavior, AKA just investing in founders that look a certain way. So it becomes really difficult if you're building a company to raise capital. So that's what we're seeing right now, if I had to just give my opinion on it.
I would say, like, we can see obviously all the uncertainty in the public market, the big retreat recently in the stock market. That uncertainty leads to private uncertainty, private investment uncertainty. So that's like, when you add tariffs on top of that, any product companies that buying things from overseas, it's just going to cause a ton of uncertainty that investors just are afraid of naturally.
Yeah, I can just speak to that a little bit. We have a fairly large portfolio and do a lot of deals every year as required. We're a state organization here to help grow the ecosystem. And one of our requirements is matching investment from other investors. Well, guess what? Last few quarters, quiet. Multiple deals fell through because the co-investors basically pulled out, because of the fears of tariffs in the market. They start seeing their stock portfolios go down and they get a little nervous about deploying capital. So that has happened in the last few quarters. Although I will say this quarter is looking fairly good so far. We'll see.
All right, I'm going to insert some of my my bias, and I'm going to ask another question. I'm also going to date myself. I started my first tech company in 2003. As we talk about the current market, from my perspective, thinking about when I started my first company, I don't know if the market today is abnormal. I think that what we saw maybe 2-3 years ago was abnormal, and we're maybe moving back to a state of normalcy. With Kofi, I do think you hit on some important points with both the negative and the positive of that, and I'd be interested in getting your thoughts on that from, anyone.
Well, 2021, 2022 was extremely abnormal, where you would have people doing 20-minute phone calls and then raising millions of dollars after that 20-minute phone call. So we were living in a different reality. This is the new reality. This is actually having an investor due diligence on your company is what's supposed to happen. It's our jobs as investors and fiduciaries to actually look under the hood to figure out, is this a company that has long-term viability, right? So that's one. And one thing I always want to say when it comes to just building a company and fundraising is, as a founder, your job is not to start a company to raise money. Your job is to start a company and build a product that people want to use. And if you build a product that people actually want to use, and it requires little to no convincing to get people to use it, AKA you don't have to overmarket to get people to use the product, because oftentimes when founders raise money, that's what they're using the money for, right? Extreme marketing, customer acquisition. If you are following those fundamentals, I think in an environment like this, you're going to rise to the top. So whenever I talk to founders, I tell them your job is to actually build a company and build a product that people want to use, as opposed to trying to figure out how to tell the best story to raise money. Because as a founder, or when you're building a company, there are two ways to make money or get money. You're either selling a product or you're raising money. And when you're selling a product, it's a much easier path than if you're raising money, because that's where you hear a lot more no's.
Yeah, 100% agree with that. In these times, it's best to fall back on fundamentals, and that's what we're seeing. I think you made a good point, Sylvester. This is more like the old normal. We hit a very frothy period for 8 to 10 years or so, where valuations kind of went crazy, money was easy, and it's not the case anymore. So.
I do miss 2021 and 2022. I'm just every investor felt like a genius.
I would say too, real quick, just thinking about like the number of startups that maybe had failed throughout the pandemic and maybe didn't start because of the pandemic, that uncertainty. I'm starting to see a lot more companies now kind of coming out of not out of the blue, but people are more comfortable starting companies now too. So that's something to think about.
Yeah, I don't miss those days. We would get a lot of flack from founders. Because even during that time, we did a lot of due diligence. And founders were getting really upset with me. Like, I just got a check and they did 3 days of due diligence. You're dragging this out for weeks. And I'm like, man, I don't miss those days. I like now people expect due diligence. It's normal.
You don't miss your portfolio being marked up by you not doing anything?
Are we getting personal? I
thought you said we were going to get spicy.
Man, you almost got me choked up. I do miss the portfolio markups. I almost started crying up here. I miss those days. I do miss those days. The days of being able to raise capital as an investor off of portfolio markups are done. As an investor, you got to show like real value to raise. It's definitely increased the bar. I do think that both on the investor side, but also on the founder side, that period created bad habits. So I guess my next question, taking that context into account is, what advice would you give founders now?
Yeah, I would say, just meet people as much as you can, as early as you can. Even if they're not the right investor for you right now, it doesn't mean they won't be interested, and it doesn't mean that they won't be able to pass you on to someone who would be. And don't be afraid to ask them, hey, is there someone you'd recommend? Is there a group you recommend? I mean, I have a whole laundry list of companies that you meet at events like this that I would say, okay, you might be good for them. I could give you that recommendation. So don't be afraid to ask. People are, available.
Yeah, I'd say come talk to us. We invest at all stages, so we are here to help as much as possible and make connections. So that's the first thing I would say. And then second, I'd just say, make sure you're bringing it forward authentically. Talk about the real strengths and weaknesses of your own company. When people try to sugarcoat it, especially in these times where we have to look even closer, it just comes off as false and it doesn't serve you. So really bring forward, the weaknesses, talk about them, and talk about how you're dealing with that or how the capital will help fix that. That's the sort of things that we're looking for because, falsehood's not going to get you very far in these kinds of markets.
And I would say back to the fundamentals, like build a company, build a product that people are actually using. One of the things that I look for is when a founder is following up with me, are you just simply following up to say, hey, following up on our last conversation, which is just noise, or are you actually following up with signal, which is following up because we just closed the deal, following up because we've actually started increasing our conversion rate at some number month over month, right? Like actually build the thing while you're fundraising. I think oftentimes founders think it's binary where it's I'm fundraising and then I'll go back to building the company. But unfortunately, this is a really, really hard job, and you have to be able to manage both.
I do think that there's a couple of points. One, I think about, I was having a conversation, we were looking at companies, like these companies are not, because the companies have spent I think that for founders, I've seen the need to shift into the mindset, to build and deliver. And with that, there's metrics. I know one of you brought up the metrics piece. A lot of founders, investors are thinking through. And I said this, and I don't, other investors disagree, but a lot of times, I'm not necessarily listening to the story, I'm listening to the metrics. The metrics are compelling, then your story becomes compelling. Metrics aren't compelling, the story is not. Focus on metrics is one of the things I see a lot from your perspective. The focus that you should see from founders on metrics in the way that investors expect. Your perspective.
Yeah, so we invest very, very early, and oftentimes, and we invest very, very early in a specific type of founder, right? We see you and we say, we think you have potential. We think you have the talent and drive to build a big company. So there's a lot of risk when we invest. And part of what we do is our first session, we actually talk about metrics, which is, that's what you need to be focused on. So as part of the program, we say, what are your 3 to 5 metrics and that you should be caring about while you're in the program? And that is the only thing when we meet on a bi-weekly basis, we start the conversation with. Did you grow this number? If the number didn't grow, do you know why? So one of the things that we're looking for is speed to experiment. So as a founder, one of the things you have to be really good at is taking in information and acting quickly on that information. You're not a big company. You don't need to have all this red tape before you do anything. So once you figure out, okay, I need this number to be growing at this percent month over month, week over week, whatever the target is, how can you get there? And everything you do is focused around your finite amount of metrics. How do you grow those metrics? How do you optimize those metrics? So, and the storytelling piece is important, but it's not as important as people think. I want you to be a good storyteller, because at the end of the day, as a good storyteller, what you're going to be doing is you're going to be trying to convince really smart people who can get a job somewhere else, getting paid more, to take equity in your company that's not worth anything right now. So you have to be able to tell a good story. But that story is much easier to tell if you also have the metrics and the numbers to back it up.
Anybody else?
No, I thought that was great. I would say, like, as long as the story's good and it serves like your metrics, it's a really good thing to include. The metrics are really great as a de-risk, like, to investors. If I know you have product market fit by selling to a handful of customers, I can do that research myself. I can say, oh, I can see where you are in the market. I can see your competitors, and I can say, okay, this competitor's like $1 billion market cap. Maybe there's a bigger opportunity here that, you know, everyone else isn't seeing. So, like, product market fit is obviously really, really huge.
And just to add to that, both comments, the basic idea that I look at is, if I give you $1, how are you turning it into 3? And that's kind of the fundamental component that leads to all those metrics, because you have some mechanism within your company that does that. That's the idea. And if you're able to do that and effectively tell me about how you're going to do that and what levers you need to pull, then it's easier to invest in you, because you show me exactly what mechanism is going to make you grow from this funding. And that's at the core of what we do. So,
I do think, John, something you hit on earlier, building relationships. There's like a back and forth that unfolds in a lot of ways. It could be updates. It's not uncommon for companies to add us to their updates. And there's companies that they added us to updates, progress, and then later on we reached back out and said, hey, or it could be a temporary managing that can be complicated. John, to your point, I have a lot. I would say usually investors can see through doesn't serve from a relationship perspective, but it is a relationship. What advice or thoughts communicate things? How do you communicate when things are going wrong?
I would say, if things are going wrong, don't be afraid to ask your investors for advice. They may be able to recommend something or someone to help you fix it. Maybe there's someone in their network they can recommend. Of course, it all depends who you're talking to. If it's like a big group or a local group, you know, that certainly helps too. But really, anybody, like, reach out to your investors, consider them like potentially advisors. You know, that's something that, it does depend on your relationship with that investor, of course, but I would say don't be afraid to rely on them. They want to see you succeed, obviously.
yeah, and before the investor relationship is, you know, the check is written and that sort of thing, when you're trying to build the relationship, be ready to be coachable. You know, look at your own weaknesses, look at the advice you're getting from those around you, your advisors, your potential investors, that sort of thing, and act on it and show that progress, because that builds the trust. It shows that, hey, I gave them a piece of advice over coffee, they went, they executed on it. Now, that doesn't mean you have to take every piece of advice. You need to work your own company the way you work your company. But being coachable is a critical component in that early stage before you get to the investment. Once you're in the investment stage, yeah, ask them for help. That's, you guys, you know, their money's in your company. They want to help, right? That's how we look at it. So,
I would say don't wait till you have good news to update an investor. You should be sending out monthly updates, and especially, so you should be sending out monthly updates to your current investors, to investors that you want to potentially have them invest in you. Maybe it's once every 2 months. Maybe with those investors, you're trying to batch like the good news. so that when they get it, it's not just, oh man, there's a lot of bad news in this company, right? There's some good news. So you can like bank the good news and then drip that good news to those investors over time. But I think sending monthly updates is a must. And the reason I think it's so important is if you think about the concept of what you're doing and what you're building, eventually I think everyone's goal, my mic just died. Eventually everyone's goal is to be a publicly traded company, hopefully, right? And publicly traded companies need to do updates every 3 months. So if you're thinking about, I have to wait, they can't just, like Apple can't tell the street, Wall Street, we're not going to give an update this quarter because the tariffs. We know we know that our stock's going to be down if we talk about the tariffs. Like, you have to give updates. So just get into that mindset, and it becomes, you start holding yourself accountable as well in that process.
So I've been talking with the microphone. I'm assuming, you're assuming everyone can hear me. So I think like coachability, there's non-number. Coachability is a big thing. Other things.
I would say just willingness to work with others. That kind of goes with coaching. But, you know, if we recommend an introduction to someone that may be able to help, like at least humor us, right? A little bit. It may help you, it may not. But at the very least, you know, you got a new network person.
I would say with the coaching thing, one piece for founders to remember is don't be malleable, meaning we run TXO is an accelerator, right? We'll put you in front of so many different people. Every time you meet someone, they have an opinion about your company. That doesn't mean just go off and go do whatever they said, right? You're still the captain of your own ship. So it's absorb the information and then try to figure out, that's part of the critical thinking of being a founder, right? I have all of these signals coming at me. Which path should I go into? And a good trick to use as a founder, especially from a relationship building standpoint, is whenever anyone gives you a piece of advice on what to do with your company, you can walk away, either decide to do it or not, but either way, circle back, especially if it's an investor, you could always circle back and say, hey, remember when we spoke and you said, try this thing? We messed around with it and we realized it doesn't really work for the model that we're doing, but we then identified this other thing. Then you keep the conversation going that way.
Yeah, I completely agree. I kind of stumbled over that part of the statement. I said specifically, don't just do everything everyone says. You can't do that, because that's totally right. Coachability is, you know, critical, but at the same time, you have to build your own company to the way it's supposed to go. So being able to hear advice, synthesize it, reflect whether it's valuable or not for your company, that is the critical leadership skill you need as an entrepreneur. So, and I think part of that is knowing yourself, right? Knowing your own weaknesses. We're good at some things and bad at others. Some people come into this with the idea like, I can be good at all of it. Well, you can't, and you won't. And the more you can identify that within yourself, which parts are your weaknesses, the easier it is to synthesize that kind of advice where it's like, oh yeah, this is a weak spot, this will help me. Or no, I got that part covered, you know.
Because that's a tough balance as an investor.
So I actually think it's pretty easy to figure out is when you tell someone, you give someone feedback, are they instantly, no, that's not going to work? Or Like, do they tense up? How are you receiving that coaching, right? Where it's being, and that also goes into leadership, where if you are going to be the CEO of a company and have a bunch of people working for you, there are going to be times where someone's going to come to you and maybe give you some upward feedback that you may not agree with, but you can't react right away, right? So it's always good to, I think, have space and time in between when you receive any level of coaching, and either use that space and time to act on it, or you can walk around and just say, man, Sylvester doesn't know what he's talking about, but you're not telling me that right away.
So the 3 minutes, best practices, things that you've seen founders.
For me, ask me to coffee. Like, I love to sit down and catch up over a cup of coffee and just understand where things are, where I can be helpful, and how we can connect. It's our mission, so for me, that's the day job, you know?
I would say just going outside of your comfort zone. You know, Philadelphia is a growing and great ecosystem, but we are not the biggest. New York's not too far. There's Baltimore, there's DC, there's a lot of places on the East Coast. Don't be afraid to go to those events too. You know, there's a lot of money out there outside this area, so it can be helpful.
I would say like high signal updates. So again, we had a conversation. We may have passed, but you have us on your update email, and we can actually see the progress of what you're building. One thing that I would advise founders not to do is, if you are pitching an investor who theoretically can invest in you but passes, I don't think you should ask them to introduce you to any other investors, because that's just bad dynamics for that investor. It may be, the other investor might say, why are you passing on it? And then that investor just has to be truthful about it. So I would just say, just high signal updates are always the best practice.
All right. We got some questions coming in. All right, so I have... Here's a good one. When should a founder raise here in Philly versus the West Coast? Does anyone have any?
I can speak to it a little bit. You should always raise here first. Little bit of bias, but yeah, I think when it makes sense to raise West Coast money, do it. We have several Philly-based companies that are West Coast funded. We partner with West Coast funds pretty regularly in our portfolio, and we're happy to do it. Same with Boston, same with New York. It's great to be able to get, you know, West Coast level checks and then spend it in Philly, where it's a lot cheaper. You go a lot further. You want to expand your runway, build in Philly, you know, get funding elsewhere, and get matching funding from Ben Franklin.
I have an answer. All right, so you're going to get my personal bias. Philly, and I'm saying this, John, we've known each other for quite some time. Philly is a very conservative investment market. And Philly often doesn't treat pre-seed and seed like true pre-seed and seed. So if you're raising and you need to raise in a market where investment is going to be treated like true pre-seed and seed, I mean, you go to the West Coast. The companies that John mentioned, I know all of those companies. I know they all went to the West Coast because they needed to raise from West Coast funds. You know, even us as investors here in Philly, because we are pre-seed more like what you would see on the West Coast, you know, sometimes we get pushback from other investors because we aren't as conservative with how we invest. As a founder, you got to raise, right? And if you can't raise here, and I would love for everyone to be able to raise here. I am as pro-Philly as you can get, but you got to raise. Your company is your responsibility. So if that means going to the West Coast to raise, you got to go to the West Coast to raise. And I would encourage founders in general to spend time on the West Coast, because Philly can be insular, Philly can be a bubble. And sometimes I talk to founders that have spent their entire time as founders building here in Philly. And they'll say things like, I have really good traction. And I'll look and say, you don't, because I just looked at a bunch of West Coast companies that look way better than yours. Or they'll say, I'm moving really fast. And I would say, you're not. Sometimes the perception can be skewed because you're building and growing here. So I encourage founders in Philly to spend time on the West Coast just to see the differences in how companies are growing, how companies are scaling, how quickly companies are moving. So, does anybody have any other thoughts?
Definitely valuations are a little bit frothier out west. I would say that. A lot of money raised on no revenue at all. And that's a big difference from like out here. Like to the conservative approach of the Philadelphia-based investors, especially ones that I know, they want to see traction. They want to see revenue for the most part. I haven't seen that much else otherwise.
All right. What are investors currently looking for in startups? I think that's a tough question to answer because every investor is different. We all have. I will say I do think. So the point about wanting to see traction, wanting to see revenue, like recognizing every investor has a very different thesis. And if you ask the four of us, like, what do we look for and how do we invest, you're going to get four different answers. We put a lot of what we're looking for on the founders and the teams. And a part of the reason is if you do the research and you look at successful SaaS companies, when those companies are successful, if you look at what they're doing and then walk back to the early stages, they're usually doing something very different than what they were doing in the early stages, which means for me as an investor, I can't anchor to a market. I can't anchor to a product. The only thing I have to anchor to is the team. So we base a lot of our assessment on the team, but that's different than other investors. So I think that what I have found helpful when you meet an investor is having a very deliberate, intentional conversation about what is your thesis? How do you base your investment decisions so you can understand how that investor sees it?